Now, so we do know that today is interest rate meeting day. That's the MPC by the CBN. And interest rate is at the core. But there are some banks that say they are non-interests. So I know you've been hearing of them. There are a couple of them already in existence. Some major ones that we know now are Jai's Bank, Taj Bank Limited, Lotus Bank, Alternative Bank. These are the major ones in existence in Nigeria now. And over the years, we've seen growth in their assets. Talking about these non-interest banks, we've seen that their assets has crossed 1 trillion naira in recent times. They've expanded. There's been increased financial inclusion, ethical finance demands to cook. We've known Sukuk for a long time, even before we start having these non-interest banks. We've seen the federal government use it for a lot of infrastructural development, and then we've seen digital banking adoption. I think most of them are digital banks, and the financing models that most of them have used is Murabha, that's cost plus financing. That's one model. There's Mudaraba, that's profit sharing. And then there's Ijara, leasing, and then there's Sukuk, which a lot of us know, Islamic bonds. There's Wakala, agency financing. And, they're supposed to drive SME growth and reduce poverty, also deepening financial inclusion. Right here in the studio, we have the co-founder and chief executive officer of STEX, Financial Technologies Limited, Mr. Habib Bailey, to help us understand some of this. Mr. Bailey, good morning. Welcome to the program.
Good morning. Thank you for having me.
I hope I didn't murder some of those names.
No.
Small. All right. So non-interest banks, does it mean they are not affected by meetings such as, what the CBN or the MPC is doing today to determine interest rates? That doesn't concern them at all.
Not necessarily. The MPR also, or the MPC meeting also affects the non-interest banks, because some of the financial instruments that they use in carrying out their day-to-day activities, like the Murabaha you mentioned, is a cost-plus kind of financing, and in most cases hinges on the movement of the MPR, right? And the same thing with the leasing contract, which is the Ijaro. So it's also as equally important as for the conventional. And the non-interest banks use this as a benchmark to determine the price they set for their financing activities. So, yeah, very, very important.
So I know, like, for instance, the microfinance banks are supposed to deal with small businesses, but their rates are really high. So does it mean that small businesses can turn to the non-interest banks? Or what are the requirements, that could be a hurdle to full access of funding from non-interest banks?
So for microfinance banks, or even the commercial traditional non-interest banks, the requirements are similar. But for some of the microfinance banks, because unlike the traditional banks, they don't probably seek collateral, so their pricing are a bit higher, right? And because of the prices are higher, it's a bit of a stretch for the businesses that seek those financing. So at the end of the day, you'd realize that for the business, they have to decide which one would they go for. If they have collateral, then the commercial banks, the traditional non-interest banks, would look more palatable to them. But without collateral, they might find the microfinance or perhaps other financial, non-interest financial institutions, or those that provide credits, more attractive, because they don't have to drop collateral.
But there's a cost. There's a cost to every fund. So what's the cost?
And the cost is because they don't have collateral. The rates at which the financing comes might be a bit higher.
That's for the non-interest banks? Even
for the non-interest banks. Right. So the other part is that for the non-interest bank, it's not just the markup. You also have the profit sharing models, where the banks look at your business case and they partner with you to finance a particular venture. Whatever profit that is made out of that business, you both share it, and whatever loss that is made, you also share the loss.
I think that's the one that's called Mudaraba.
Exactly.
Mudaraba. Okay.
Yes.
So Is it for startups, existing businesses, or what level of business could do this profit sharing with the bank?
So first and foremost, usually the banks determines the kind of financing instruments that they use.
Okay, so
and I think,
if a business approaches the bank, then the
yes,
bank would, assess
exactly.
the business and then propose
Yes,
different types.
and I think that's part of the beauty, right? You need to understand the business needs, and from the varying financial instrument that you have, you propose a particular one. For instance, there are businesses that maybe they need working capital. You could go and you think using the cost plus, which is the Morobaha, might not be attractive or suitable enough for that business. Then you determine the kind of financing that you use. For instance, we have for our organization, we have a subsidiary that is SEC licensed. We try as much as possible to also advise some of these businesses. Then, based on the advice and the suitability, we send them to our lending arm to provide this financing. So, at the end of the day, what determines the kind of financing is the current need of the business. And I tell people a lot that this is one of the beauty of non-interest finance. So you could use the Morobaha, which is cost plus, particularly for businesses that are trying to finance their inventory or they're trying to finance an asset, right? You could use Ijaro, which is the lease kind of financing. Maybe you want to buy an equipment. So Ijaro could be more suitable because the bank holds that particular asset in its own name and they lease it to the business. So the business uses it for a particular period and the bank eventually sells it. And there's a great deal of benefit in these different financing models. However, a lot of people still don't know much about this instrument, though there's growing awareness about some of these instruments. And as you can see, I think this year, late last year, the Central Bank of Nigeria approved Bank of Industry to open a non-interest window. And the Development Bank as well is also doing a lot of work in that regard. So there's a growing momentum around non-interest financing in Nigeria because if you look at, for instance, from a financial inclusion point of view, the northern part of the country, you found out that majority of them would not take interest-based financing. And that's why there's a growing interest in that space to see how non-interest financing can penetrate. Because based on EFINA statistics, while we have tremendous growth when it comes to financial inclusion in the southern parts, the northern parts, there's still a lot of work to be done. Apart from people being able to open accounts, the financing gap is
because I wanted to ask, when we talk about adoption, if religion comes in, because as you noted, I mean, when you talk of non-interest bank, is Islamic financing,
yes.
and is that a hurdle in the southern parts of the country?
Not necessarily, but it plays a part, right? And because there are people that would not necessarily take other forms of financing if they don't have the one that is non-interest, of course. While some people, whether it's non-interest or interest-based, they won't just go for it. We've come across businesses like that they prefer
people who don't want to owe. I know that
exactly, they don't want to owe at all. Yes, they don't want to owe. They'll tell you that I want to sleep well at night, right? So you have that category of people, and you have categories of people that because it is interest-based, they won't go for it. And you have the category of people that, in as far as it is not interest-based, they're fine with it. So the overarching thing is that we need to be able to sensitize people more the benefits for those that their business actually need this financing to eventually grow. For instance, we financed a particular business that was dying, started with about 10 million naira, right, and increased the amount over time. The business is now close to doing 1 billion naira, from a business that was close to dying to now grossing about 1 billion naira in revenue.
But how does non-interest banks, how do they deal with bad debts?
So it's almost similar to the way your conventional will do it, but there's a little bit of, should I say, respite. So for instance, if an Islamic bank finances a business and the business defaults, right? The first step is to, as much as possible, try to see how you can recover it, right? And if it's proving difficult, of course, you have to probably try to classify it as bad debt or something. However, there is a penalty charge that Islamic banks are allowed to, of which they are not expected to earn from it. They are to give that proceeds to charity. These are some of the differences between the conventional and non-interest banks.
All right, thank you so much. Sounds interesting and something that we should explore further. Mr. Habib Bele, the co-founder and chief executive officer of STEX Financial Technologies. Thank you for your time.
Thank you very much, ma'am.